There are over 44,000 banks all across the world, managing literally hundreds of trillions of dollars in assets, and yet most people have no idea how the banking system actually works because nobody explains it properly. If you want to know how modern economies work, then this is something you have to understand intuitively. So in this video, we're breaking it all down without breaking your brain. This is the banking system explained. Welcome to Alux, the place where future billionaires come to get inspired. Now, before we talk about how banks work, we have to understand why they exist in the first place. And the funny thing is, the story doesn't begin with money the way we think of it as today. Thousands of years ago, long before anyone had ever seen a debit card or a balance on a screen, people stored stuff that mattered to them. Grain, metals, goods, somewhere they wouldn't get stolen. And there were a few clever people who decided to provide storage as a service, basically saying, "Trust me, leave your stuff here, it'll be here when you come back." So when people started using gold and other metals as currency, these storage services were forced to evolve into something more like a modern bank. It turns out, for the average person, walking around with a big bag of gold coins is not just exhausting, but it's also pretty dangerous, and so instead of keeping their gold themselves, they would take it to the bank. And in return, the bank would give them a piece of paper that basically said, yes, this person deposited this amount of gold here. At first, these receipts were just a way to come back to the bank of your gold. But then something interesting happened. People realized they didn't even need the gold. It was much easier to trade the receipts. They were portable, they were trusted, and they could always be traded in for gold. So that's how they got paper money. And this is the moment the idea of modern banking takes its shape. So when paper money was widely adopted, the banks noticed that people were leaving their gold with them for longer periods of time. Most people stored it for months or even years, and the gold mostly sat there doing nothing. So some banks started lending out a small portion of it. Gold they technically didn't own, but they did it because they knew the odds that everyone suddenly coming back to the bank demanding their gold at the same time was pretty low. The people getting these loans would have to pay them back eventually with some interest on top. And from there, the final major shift happened in 1971 when the US dropped the gold standard entirely. So now, instead of money being a claim on the gold you had in the bank, it was just valuable in and of itself. This is what we call fiat currency, money backed by nothing but our collective belief in it, and that led to a massive evolution in the banking system. And that's the world we live in today, but that's also the part that makes understanding the banking system so confusing. If banks don't really store much of anything anymore, then why do we still need them? Well, there's basically two answers to this question, and they actually show one of the coolest things about money as a whole. So the first answer is that these days when we say banks, we're not just talking about one kind of institution. There are many different kinds of banks, and each part of them plays a different role in how money moves through the world. Most people only ever deal with retail banks. These are the everyday banks that hold your checking account, provide a debit card, and offer services such as mortgages and credit cards. Their entire purpose is to serve individuals and small businesses, but they're only the public-facing side of a much larger industry. Behind them are commercial banks that provide similar kinds of services but for businesses instead of individuals. They're the reason a restaurant can open a second location or a factory can afford new machinery. Then, in a completely different category, you've got investment banks. Their world is the world of capital markets. When a giant corporation wants to buy another giant corporation, or go public on the stock market, or sell an entire division, investment banks are the ones putting the pieces together. And above all of them sits the central bank, which we'll talk about a bit later. But here's the thing. Even though these types of banks look completely different on the surface, they're all built on the same underlying idea. And that is the second and most important reason why we still need banks. Because without them, we would probably still be in the Stone Age. Now, before we explain that, if you're watching this video, we're willing to bet that you're the kind of person who actually cares about wealth, success, and building a better life for yourself. Here at Alux, that is exactly what we're all about. It's why we built the Alux app, to teach you about wealth creation and help you to become the ultimate version of you. Inside the app, you'll find daily lessons that help you to level up your money, intelligence, fitness, and even your confidence in relationships. You'll also get access to full courses from industry experts on topics like entrepreneurship, sales, even building confidence in your relationships. The kind of skills that actually move that needle forward in your real life. You can test out the app for free today by going to Alux.com/app or clicking the top link in the description of this video. And if you scan this QR code on screen, you'll get 25% off our yearly plan and access to everything we've got to offer. Invest in yourself, my friend, because when you grow, that money follows. All right, let's get back to the video, shall we? So, the second reason we still need banks is that without them, the economy would be so tiny that pretty much nothing would ever get done. It all has to do with something called fractional reserve banking, and this is how it works. When you deposit $1 million into your bank account, it's tempting to imagine that they keep it in a big vault with everybody else's money, but that is not what happens. The bank doesn't actually have your $1 million stored. They only keep a small percentage of it in cash or reserves. Instead, the vast majority of that money gets lent out or invested somewhere else. Your balance is really just a number in a database. You can ask for it back at any time, and the bank is obligated to pay it back even if they don't have all of it. Now, this system works because, again, banks have more customers than just you, and it's pretty unlikely that everyone will ask for their money back all on the same day. But here's where things get interesting, because by loaning out the money people have saved up, banks are creating massive economic ripple effects. Think about it like this, okay? Modern banking feels mysterious until you realize that at its core, a bank is simply a middleman. And middlemen get a bad rap because, let's face it, they usually just make things more complicated and expensive, but in this case, it's a bit different. Banks are laying the infrastructure for a society-wide process that couldn't possibly happen without them. Basically, banks connect two kinds of people. The first are people with money they're not currently using, and the second are people who need money to do something productive. The reason this is fascinating to us is that, economically speaking, a dollar that doesn't get spent is a dollar that practically doesn't exist. But by organizing this exchange at scale for millions of people every day, banks make sure that every dollar goes as far as it possibly can. And a dollar that does get spent is actually worth a lot more than a dollar saved. The easiest way to understand this is with a simple example, okay? Imagine you walk into a bank and deposit $1,000. The bank might keep 100 of those dollars on hand and lend out the remaining 900 to someone who needs a loan. The borrower spends that money, maybe on a laptop or paying rent or buying something, and whoever receives it eventually deposits it into their own bank account. And just like before, that bank keeps a small portion, maybe $90, and lends out the other $810. That money gets spent, deposited, and lent out again and again and again, and eventually your $1,000, which would have sat in a vault somewhere, ends up accounting for around $10,000 of actual economic activity. That's the beautiful thing about the banking system. Every deposit ripples through the system, and as a society, we all benefit from it. It doesn't matter if it's a business loan, a mortgage, or if you're simply swiping your credit card to pay for groceries. When money is in the hands of people who are going to use it, it means more businesses, more jobs, and more investment into ambitious projects like investing billions of dollars into cancer research or technology or building a city's infrastructure. And it's all funded from the massive pool of money from millions of people who have nothing better to do with it than stick it in the bank. So as you can see, if it weren't for banks, the global economy would be a tiny fraction of the size it is today. So if anyone ever tells you that money is the root of all evil, you can tell them it's also the root of most progress. All of this to say, this is why banks exist and why we still need them. They connect underproductive money to people who want to make it productive, massively growing the economy in the process. However, it's not all sunshine and rainbows. Like any system, banking isn't perfect. Right now, you can say that you know how it works, when it works, but if you really want to understand it, you have to see the moments where it doesn't. Because that's where you can start to see the flaws and its limitations. Unfortunately, there have been a few times when the banking system itself failed. So how does that happen? Well, let's look at how individual banks fail first. The most classic way is a good old-fashioned bank run, when too many people try to withdraw their money at the same time. Remember, banks don't actually hold most of your deposits in cash. So if customers suddenly panic, even a perfectly healthy bank can run out of money. This is what happened back in the Great Depression. Hundreds of banks collapsed because they didn't have enough cash in reserve when people started flooding in demanding their money back. Another way that banks fail, which is much more common nowadays, is because of bad loans. Banks are businesses, right? They want to make as many loans as possible to make as much money as possible. But if you leave them unchecked, they're going to start giving out some riskier loans to people who may or may not be able to pay them back. If the bank fills its portfolio with enough of these risky loans, and enough of them go bad at the same time, the bank loses too much money and it collapses. This is what happened back in 2008 when banks were overloaded with risky, overvalued mortgages that people couldn't pay back. But here's the thing. One or two banks failing here and there isn't really the problem. An economy can handle that. The problem is that banks are so interconnected, borrowing from each other, settling payments with each other, that if one bank fails, it might trigger a chain reaction that spreads throughout the entire world. That's what really happened in 2008. So when you pull all of this together, you start to see that the banking system is always sitting in a really delicate balance. On the one hand, they're responsible for making money as economically productive as possible. As a society, we want them to make as many loans as possible so that the economy grows at the optimal rate. But on the other hand, if you leave banks unchecked, they'll inflate the economy more than they should, and everything can come crashing down. Basically, the banking system has to be handled with care, and that's why pretty much every country has what's called a central bank. So basically, a central bank is the bank for other banks, and its job is to oversee the entire system from above. One of the things they do is to help banks settle payments with each other. They also work as a lender of last resort, which means if a bank is facing a bank run, they can borrow money from the central bank, preventing the sort of domino effect we were talking about earlier. However, a central bank's most important role is basically regulating the economy. In the US, for example, the Federal Reserve has what's called a dual mandate. Their job is to keep inflation low and employment high. And without making things more complicated than they need to be, this is how they do it. Banks often take out loans from each other so that they can make more loans to their customers. But just like any other loan, they also have to pay them back with interest. The thing is, the Federal Reserve has the authority to change the interest rate. By making it go from 2% to 3%, for example, they make it more expensive for banks to borrow money from each other. And that means they'll take out less loans, which means they'll give out less loans, which means the economy will grow more slowly. If you're seeing inflation rise, then that is what you want. On the other hand, if the Fed drops interest rates, borrowing money between banks becomes cheaper. They lend out more money and the economy grows faster. If you're seeing unemployment rise, then that is what you want. So the Federal Reserve's job is to walk this tightrope, to keep the economy growing without letting inflation get out of hand. It works slightly differently in every country, but the Federal Reserve is the one you'll hear about in the news, so now you know. If you zoom out, we've covered a lot here today. You've seen why banks exist, why we still need them, how they fuel the economy, how they fail, and even how the banks that regulate other banks work. It's a hell of a system, right? Honestly, it's astounding when you realize that all of this just kind of happens in the background of your day-to-day life. But that's the thing about the systems that we've built as a society. When you unravel all of the complexity, they're pretty impressive. We've come a long way from trading cows and seashells. So yeah, alright, we hope that this video helped you to finally make sense of how the banking system actually works. If you learned something new here today, go ahead and give this video a like. And remember, you can dive deeper into topics like this inside the Alux app and actually use them to build wealth. You can try it out for free by going to Alux.com/app or by clicking the top link in the description. With that said, take care, my friend. We'll see you back here next time.